Having a pension sounds simple. You pick a payout and you're done. You've done the hard work. But for families with 1 to 10 million in investable assets, it's rarely that straightforward. The pension decision impacts taxes, estate planning, Social Security, and much more, and even how you invest the rest of your portfolio. In this video, I'll walk you through the biggest mistakes and things to consider when making this decision. The first one is tax coordination. When deciding between lump sum versus an annuity payout, has major tax consequences, and it really depends on a number of factors like other income sources, your Social Security. Are you looking to do Roth conversions? When your RMDs begin, overall tax bracket management, if you're in a high income state, or if you're in like a Texas or a Florida that don't have income taxes. These are all things to consider, as well as like your spouse's health, their age. These are just things that people often overlook when deciding that lump sum versus annuity, as well as should the surviving spouse get 0, 50%, 75, 100%, because obviously those decisions reduce your monthly payout now. Social Security and Medicare timing. So how your pension income interacts with Social Security, as well as how you can stack those. So if you've got $3,000 in pension income, as well as Social Security, that's $3,000 or $4,000 plus potentially a spouse's Social Security, these all add up, and at a certain point will impact your IRMA and some of the other things that we hit on in the first section around tax coordination. So estate and legacy planning, this is something people often totally overlook. So when pensions often die when the retiree and the spouse are gone, if you took that lump sum, it could be rolled over to an IRA and passed to your heirs. So just something to consider. Often depends on your other accounts and your overall financial situation and what your goals are. You can using pension decisions to fund charitable strategies. This is something that we see as well. Say you secure your income needs for, say you spend $10,000 a month, and between your pension and Social Securities, you make $11,000 after taxes. So then you have a large taxable account. You could use that to potentially seed a donor advised fund. Health and longevity, as well as the spouse's age. This is especially important if one of the spouses is significantly older or younger. Or if there's been a recent cancer diagnosis or any other health-related or longevity-related factors. Investment allocation. Once you have secured your income for the foreseeable future, this just allows you to potentially, if you want, to take more risk in your investment accounts, to really let those things grow if you're not needing them, or if you don't plan on touching them for the foreseeable future. It can change how you're allocated and what that risk and growth profile of your accounts looks like. Potentially allows you to incorporate more alternative or private investments. Inflation and purchasing power. We've all experienced inflation in the past couple of years. Most pensions don't have an cost of living adjustment. So what is the risk of that over 20, 30, 40 years of potential retirement? Nobody likes to think about this one, but companies do go under. Pensions are unfunded, and you run into issues there. So the risk of an underfunded plan. And so is it worth considering diversification outside of your employer risk and taking that investment risk on yourself? These are just things to consider. Obviously, everybody's situation is different, but this is what we help clients think about as they're making these decisions. Philanthropy, we've already hit on that a bit. So put simply, for high net worth households, pension choices are just one piece of the puzzle. You also have to consider tax, estate, risk management, longevity, health, because these mistakes, when done incorrectly, can cost you significant amounts of money. So appreciate you tuning in. If you enjoyed this, please watch the next video. Thanks.